Gentleman from Kentucky, Mr. Barr, the chair of our Financial Institutions Subcommittee, you're recognized for 5 minutes.
Thank you, Mr. Chairman. The Dodd-Frank Act established a number of regulatory requirements for community banks with $10 billion or more in assets. In the 15 years since its passage, the economy has grown, meaning that banks must also grow to compete and stay competitive against their largest peers. But the thresholds on community banks have remained the same. That's why I'm drafting legislation that indexes certain regulatory thresholds for community banks to nominal GDP. I often hear from community banks that the costs of complying with these regulatory requirements impede them from growing past the $10 billion threshold, leaving them unable to compete and grow, which threatens the survival of the community bank ecosystem altogether. Specifically, the Durbin Amendment is the most costly and burdensome requirement that these smaller banks face. Vice Chair Bowman, does the current $10 billion threshold disincentivize community banks from growing, and what does this mean for the competitiveness of the community banking sector?
In my experience in working with community banks that are approaching the $10 billion threshold, it certainly does disincentivize their growth. It gives them few options to be able to address the additional supervisory requirements that are imposed at that threshold level.
Yeah, that's my experience as well, talking to kind of larger community banks in Kentucky who are approaching that $10 billion threshold, growing organically and in a healthy and safe and sound manner, but then are, because of the Durbin Amendment and some of these other regulatory triggers at $10 billion, they want to grow, but they have to rapidly expand their balance sheet and increase their presence in new markets and activities and new business lines to account for the additional interchange costs that they would face over $10 billion. I would think that this would raise financial and reputational risk. Vice Chair Bowman, is this counter to regulators' safety and soundness mandate, and would indexing the Durbin Amendment and some of these other requirements and these other thresholds allow banks to grow in a more organic and safe way?
Indexing as a general concept is an important improvement that could be applied to especially the community banking space, but I think it also could be helpful for other sizes of smaller institutions as well.
Well, thank you for that. Last Congress, many of my colleagues and I worked tirelessly to bring to light concerns with the Basel III Endgame proposal, including traveling to Switzerland to speak to the Basel Committee, where they agreed with members of Congress, a bipartisan delegation, that the U.S. proposal from your predecessor, Vice Chair Bowman, proposed gold plating requirements on American financial institutions compared to their global peers. Fortunately, that proposal was never finalized, and the Fed, OCC, and FDIC plan to reintroduce a rulemaking in 2026. To all of the bank regulators here, Vice Chair Bowman, Comptroller Gould, and Acting Chair Hill, will you commit to undertaking a holistic review of the capital stack to account for double counting and other duplicative capital regulations on U.S. firms? We can just go down the line.
Absolutely, we're doing that now.
Mr. Gould?
Yes.
Thank you. And are the agencies, to all of you again, are the agencies planning to issue a proposal that predetermines a, quote, capital neutral outcome, even if some risks continue to be overcapitalized?
We don't have a preconceived notion about where we'll land with our capital requirements based on this review, this holistic, this comprehensive review of capital that we're undertaking now. We're looking at it from a risk-based approach by each factor and category of risk.
Well, let me just reclaim my time because I'm running out. My view to all of the regulators here on this issue of capital neutrality is that an America First banking regulatory agenda should not seek to just achieve international regulatory harmonization for harmonization's sake. Instead, it should seek to advantage American economic competitiveness. Of course, safety and soundness, of course, making sure our banks are well capitalized, but we should not just simply be looking for international harmonization in the implementation of Basel III. We should be focused on economic growth as we balance economic and financial stability as well. Final question to Mr. Gould, Comptroller Gould. We're seeing a massive increase in energy demand because of AI data centers and the race for AI. This scenario implies significant stress on the U.S. power grid that will require major investments in generation, transmission, and grid infrastructure. I want to talk to you about removing reputational risk from your regulatory oversight agenda. Does that mean you're going to be able to greenlight bank lending to the sources of the most reliable and affordable energy, including coal mining operators and utilities interested in investing in coal?
The gentleman's time has expired, and we ask the comptroller to respond to the gentleman in writing, please.